Hello, my name's Jerry Weston. This is my presentation, Lessons Learned, a comparison of the Great Depression and the Great Recession. For my presentation, I chose to respond to a CEO in the banking sector. The CEO is concerned that there may be a correlation between the Great Depression and the Great Recession. His concerns are that history may again repeat itself. My approach was to ensure the CEO that, first and foremost, his concerns are being heard, and to provide a fact-based comparison between the Great Depression and the Great Recession. I chose to focus on the banking sector as it is one I am most familiar with. My first fact, more than 9,000 banks closed in the years that led up to the Great Depression. That's true. But as significant as that was, it's important to keep perspective. The banking sector had experienced a significant expansion prior to the Great Depression. So great that profitability and bank size had in fact contracted. In 1886, the average bank size was $1.04 million. In 1896, 10 years later, the average bank size was $660,000. That's a contraction of more than 35%. Given the rapid growth, it's unsurprising that many banks lacked adequate resources. Given the competitive employment market, it's also unsurprising that many banks lacked adequate managerial resources. The Banking Act of 1933 implemented safeguards in response to the bank failures of the Great Depression. Ensuring deposits had the positive effect of encouraging faith in the banking sector. The threat of receivership, the action of assuming control and liquidating closed banks exercised by the FDIC, nurtured the public's faith in the process. Requiring membership in the Federal Reserve controlled entry into the sector in response to the preceding out-of-control growth. As a side note, the Financial Services Modernization Act of 1999 repealed some of the Banking Act and created financial holding companies. This allowed banks to be part of umbrella organizations that transacted other financial services that were prohibited in the earlier Banking Act. This expansion expanded the scope and the scale of the sector and made banks vulnerable to the actions of their subsidiaries held by the established holding companies. Flash forward 70 years later. Between 2007 and 2013, the Great Recession realized the closure of 489 banks. As recently as December of 2017, depository institutions carried more consumer total debt outstanding than at any time during or before the Great Recession. Our CEO's concerns are not totally off base. In response to that fact, I counter. Bank closures during the Great Recession occurred after the fourth quarter of 2008. By that time, funding pressures had abated. That fact suggests commercial bank failures during this episode cannot be attributed to the bank's inability to meet their short-term debt obligations, as occurred during the Great Depression. So there is a difference. Since the Great Depression, since the creation of the FDIC, and since the Federal Reserve has been giving more power and more control, banks are now required to hold reserves. These reserves act as safety nets, institutional safety nets, and are based in part on historical information and expected losses. The Great Depression and the bank failures of the Great Depression were in part the result of the expansion of banks. Banks expanded because agriculture expanded. So banks expanded in agricultural communities, um, and that's consistent with the growing value of that sector. Unfortunately, you also suffer the vulnerabilities of that sector, or banks also suffered the vulnerabilities of that sector. So when agricultural prices started going down, bank performance started to slide. 70 years later, the Great Recession, exposure that mattered most were loans and credit lines. The dependence on agriculture is now mirrored on the dependence on consumers and consumption. Banks that were part of subsidiaries or part of holding companies also shared the same vulnerabilities as the other subsidiaries, the other financial service organizations. Financial service organizations tied to real estate, for instance, made those banks especially vulnerable as real estate prices started to fall. In the fourth quarter of 2017, delinquencies and charge-offs increased from the prior quarter. That's correct. The CEO noted that. But if we do a 12-month look back and look at the fourth quarter of 2016, we actually see an improvement in 2017 of 23 basis points. That's significant. Net charge-offs increased to their highest level since 2013, and we go back to commercial real estate. So the CEO's concerns are not entirely unfounded. But consumer debt can be argued it can be argued that increasing consumer debt is a response to low interest rates. It's just in the past year that the Federal Reserve has started raising interest rates. 3 increases in 2017, with as many as 4 projected in 2018. The positive effect of increasing rates, consumers may become more discriminating. They may become more selective in their borrowing. The expectation of inflation may actually further curb that. We learned many lessons from the Great Depression. Many economists attribute the length of the Great Depression not to bank irregularities or bank failures so much as to government's failure to respond. That was not the case in the Great Recession. In the Great Recession, government responded quickly, rapidly. Programs such as TARP protected businesses. Entire organizations were bailed out to protect the overall economy. It's my sense that presenting this to the CEO gives a balance. Are his concerns that a future recession may mirror the Great Depression? Perhaps. I can't dismiss that entirely. But what we do know about recent history is one, government will respond. Two, the FDIC will respond to protect depositors. The combination of those two and monitoring by the CEO, by the banking sector of current performance and future performance are all the safeguards necessary to see what's coming. Banking relies on projecting what's going to happen in the future, monitoring delinquencies, monitoring charge-offs, monitoring loan growth, monitoring credit outstanding. All those measurements and metrics contribute to the safeguards that protect the banking sector. Thank you very much. I hope that my presentation was informative. Enjoy your evening.